Well, hi, good evening, everyone. My name is Karen Forrest, and I am a marketing coordinator at Great Credit Union. And I will be your facilitator for tonight. Before we begin, I'd like to welcome and thank everyone who's here joining us. We hope that you're all excited to learn about the home buying process. Our host, Ryan, will be sharing some tips on how to organize your finances and how to prepare all the necessary documents to help you get to your dream home. We also have some housekeeping notes. We ask all attendees to please turn off their cameras and their mics. If you have any questions, please type them in the chat and we will go through them after the presentation. So, to officially kick off our webinar, I'd like to welcome Ryan Lopez, who will be our host. He's our senior mortgage loan officer at the credit union. So let's all please welcome Ryan.
Hello, everybody. I am Ryan Lopez, and as Karen said, I am a senior mortgage loan officer here at Create Credit Union. I have been a mortgage officer for 26 years now, and I've always worked for credit unions here locally in Las Vegas. Just to give you a little bit about me, I grew up here in Las Vegas. I've lived here my whole life, and I went to Gorman and later UNLV, and then I started doing mortgages. So that's kind of how I started. When I was in college, I was actually like a pre-med major, and I was working at a credit union and started working in the mortgage department. And that's kind of how I started doing everything and buying my own homes. And by the time I was 28, I was able to purchase three homes. And often my friends would say, how did you manage to buy three homes? And it was because I worked in that department and I had the knowledge to do so. So that's kind of what we're doing here, is trying to present some of that knowledge to prepare everyone to be able to do the same things. With the name change to Create Credit Union, one of our slogans now is create the life that you want. And that kind of goes hand in hand with home ownership. So to get everything started, we'll start going through the slides here. So we're going to be talking about positioning yourself for home buying, things you'll want to do to get ready to purchase a home, and what we'll be looking at and what the lenders look at when we're getting ready to buy a home. There's a couple different steps that are involved, right? You want to save for a down payment, review your credit reports to, boost your scores or repair your scores, get pre-approved, hire a real estate agent. You're going to, search and look for the perfect property, submit your offer on that property. Maybe your offer gets accepted, maybe it doesn't right away. Sometimes you have to make offers on, 4, 5, 10 homes, and sometimes you go out that first weekend, make one offer, and it gets accepted, right? Then once it's accepted, you'll start to plan and prepare for closing. You'll sign all the important documents for closing that you'll need, and then you'll get your keys and you move in, and it's happy day and we all celebrate, right? So to go through all this, we're going to start talking about saving for home ownership, right? So when you're saving for home ownership, there's a couple different ways to go about it. There's things you're going to have in the home buying process that will be expenses, like your down payment, right? That can vary depending on the type of loan you're doing. If you're a first-time home buyer, if you're not a first-time home buyer, if you're eligible for some down payment assistance programs, those kind of things, right? Traditionally, if you're doing an FHA loan, they require at least 3.5% down. Conventional loan is 3% down. You'll also have closing costs that you'll need to prepare for. And depending on the type of loan you're doing, your credit scores, all those kind of things, closing costs can vary. With the credit unions, since we're nonprofit, our closing costs tend to be very low compared to other places. But you'll still have, your appraisal cost and the title company's cost. And, the county is going to charge you for recording, all those costs involved there, right? Then there's other like post-purchase expenses. These are expenses you might have after you close on your loan, right? So moving, if you're going to hire movers or hire a moving truck or just get a couple of buddies to come help you move, you might have to buy them pizza or whatnot to entice them to help you out. Insurance is security. Are you going to set up a security system in your new home? Do you want cameras? Do you want, live monitoring? All those things to consider. And then, of course, repairs, renovations, furniture, that kind of thing, right? I always joke that people will search and search for the perfect home. And then once they find that home, they decide to change everything about it. They're like, let's knock down this wall and make this room bigger. And, let's take out all the flooring or take out all the cabinets, all that fun sort of thing. When it comes to, renovations and furniture and even things like that, the important thing is to remember while you're in the process of getting approved for your home loan, don't start acquiring the furniture and the flooring and things you want to do just yet, because those expenses can build up and affect your credit or increase your debt to income ratio, which then will mean you can't get the house. So wait until you get your keys in hand and everything's done to start doing those things, right? And then saving sources, right? What are some different saving sources you can get? Automatic deductions is one of the biggest ones, of course. You can set up to have automatic deductions from your payroll, go into savings, go into a CD, go into a money market. One of the biggest ones that sometimes people don't participate in is your 401k contribution. That can be huge because, of course, if your employer is giving you a match, then those funds can grow, and you're able to tap those funds for a first-time home purchase. So that's a big one where if you start doing a contribution to your 401k within a year or two, you can have some significant savings there to use to purchase a home. Gifts are also allowable. You can get gifts from family members. Sometimes you can even get a gift from a close friend if you can document the relationship for a while. And of course, selling of assets, right? So if let's say you have a vehicle that's paid off, you can sell that vehicle and document the sale with a bill of sale and all the paperwork, and we can count that as funds for closing. I've even had people who have sold collectible items. I had a borrower once who he was a sneakerhead. He had a shoe collection of various, Nikes and different sorts of shoes. And he sold 3 or 4 pairs of his shoes to come up with the down payment that he needed to purchase a home. I've had people sell jewelry. And again, as long as we can document the value, we'll get, whatever that is appraised. Like if it's jewelry, you can have a jeweler give you an appraisal of it and then a bill of sale, and we can document that, what the value of that asset was for the underwriter. So that's, different ways you can go about saving, right? And then let's go to our next slide here. And so we have the next part would be, of course, reviewing your credit report. So one of the big components of getting a home loan is your credit score. And it's not just the score, but it's also what's on your credit report, what your debt to income ratio looks like. A lot of that information is going to come from your credit report. So credit reports are, of course, important in determining your mortgage approval and the interest rate. Not only does your score determine what kind of interest rate you get, but if you're doing like a conventional loan, the mortgage insurance rate can be affected by what your scores are. So that's stuff to keep in mind, right? Nearly 90% of lenders use the FICO score model to determine a mortgage loan. They range from, a low score of 300 to 850. And of course, the higher the score, the better. Most the lowest you can usually go with an FHA is about a 580 score, and a conventional loan requires a 620 score. For VA, it can vary, but often they'll match FHA and go down to a 580 score. And then you'll want to check your scores well before applying, because improvement can take a little bit of time depending on what's on there. Also, you might have fraudulent stuff that's on there that you didn't know about. Sometimes people aren't even aware. And so this will give you some time to clear any of that up or get that removed or address anything that might be showing on your credit score, right? So different ways you can boost your credit scores, right? Raising your FICO score will improve the likelihood of being approved and a better interest rate, right? So the big things you want to look for in terms of your credit score is making payments on time. That's a huge component of your overall score, right? Paying down balances. If you have revolving credit, one of the big criteria that they look at, it's almost even bigger than your payment history or late payments, is how much of your credit you're using. So if you have a credit limit of $5,000 and you're at 4,500, that can be an issue, right? Usually they want your scores to be under like 30% of the limit that's on the card. So that's one of those things you want to keep in mind for revolving accounts. The other thing is if you have older accounts, you want to keep those open. Sometimes you might have an older account that you've had for years and maybe you're not even really using it, but the history of that account makes your scores a little bit better. So the longer you've had that credit, the better. If you're thinking about closing accounts, newer accounts are the better ones to close versus older accounts, right? And then limit applications for any new credit. So this is inquiries. If you're going around and you're looking for different, inquiries or whatnot, let's say you're shopping and you're at one department store and they offer to, give you a 10% discount if you, open a new credit card, that inquiry is going to ding your score. We see this a lot around the holidays where sometimes people will just apply to get a discount when they're doing shopping. So if you're out or in the process of buying a home and you're, out shopping, you're thinking maybe you want some of these discounts, just keep that in mind that you don't want these inquiries dinging your score. One of the final things we do when we do a mortgage before we fund the loan and everything is we do what's called a credit refresh. So we won't pull a new credit report at that time, but we're going to update the one we did 30 days prior. And what we're looking for is, are there any new inquiries? Have there been any new accounts open? Have your payments gone up? Have the balances gone up? And sometimes people will go out and do that, like I was mentioning before about, not getting furniture or not buying new flooring or doing those kind of things, because that can affect those, the credit balances, your credit payments, and then make it that you can't qualify. So you want to, avoid doing that. Your credit report lasts for at least 60 days for applying. You want to apply kind of a little bit ahead of time, because again, if you have something that you need to address or fix, you want a little bit of time to do that. So 60 days is a good time, right? You want to be mindful of non-traditional credit scores, right? Don't abandon like your rent payments or your insurance or utilities. Sometimes we may have to look at your rent history to approve you for the home. And if that happens, you know what I mean? If they see a late payment on there, it's going to cause a problem when you're trying to qualify to purchase a home. Insurance and utilities too. If you, excuse me for a second, get a drink of water. But if you don't have a credit score, we can sometimes use a non-traditional credit report to build your score. And in those cases, what they'll look at will be rent, insurance, utility payments. Sometimes they'll look at like cell phone bills and other things like that. But in that scenario, you want to make sure you're not showing any late payments on there in case we need those for the loan. So let's see, on to the next slide, right? We have, what is involved with getting a mortgage loan, or how does it start? So often you'll hear that you'll want to get pre-approved. And sometimes you hear some people say they want to get pre-qualified. And a lot of people don't realize what the difference is between those two, right? So a pre-approval is a firm commitment. A pre-approval means that you have submitted all your documents, pay stubs, W-2s, tax returns, bank statements, all those documents that we need to verify to confirm that you're approved for a loan. We'll pull credit, we'll run it through whatever automated underwriting engine we might need, whether it's Fannie Mae or Freddie Mac or FHA, and we're going to get an initial approval based on that criteria we have, right? You'll want to get pre-approved before making an offer. Often, a realtor won't even take you looking for a home unless you have a pre-approval letter. And if they do, often you can't make an offer without having that pre-approval letter in hand, because otherwise the seller won't know that you can actually afford to buy the home. Now, a pre-qualification is basically just some, looking at some quick numbers and giving you an idea, like a rough idea, if you may be able to get pre-approved. Like sometimes people will call me and they say, hey, I make X amount of money, per year or per month, how much could I afford? And really quickly on the phone, I can say, okay, well, if you make X and I divide that by 12 months to see what your gross monthly income is. And then from there, I say, the max we could do for a debt to income ratio is 50% of your gross monthly income. And then from there, I'll start working backwards and I'll say, okay, do you have a car payment? Do you have student loans? Do you have this or that? And I'll just subtract all those debts that you might have from that income. And then that'll tell me what your max monthly payment could be. But even then, it's just a rough idea, because like the income figure you gave me may not be correct. And I won't know that until I can actually look at your pay stubs or your W-2s and make sure that's accurate. So if you have a pre-qualification, it's not really worth the paper that it's written on, and most realtors or sellers won't accept that as, to go along with an offer showing that you're pre-approved, right? So application criteria, of course, what are we going to look at? We already talked about credit score. They're going to look at credit score. We're going to look at assets. They're going to want to make sure that you have the funds necessary to close the loan. If you're doing just 3% down, they're going to want to make sure you have that 3%, but also that you have the closing costs that you might need. All those things will be in there. Employment history, right? Often they're going to want to see that you have a 2-year employment history. Now, that doesn't mean that you have to be employed with the same employer for 2 years. It just means that we have to show that you've been employed for 2 years. Often they do want that employment to be in the same line of work, though. So, like if you've been working as a teacher and then you switch from one school to another or one school district to another, or maybe from public to private school or vice versa, it still all kind of counts as a 2-year employment history in that line of work, right? But one of the issues that can come up is if you have employment gaps. There's not a problem if you change jobs frequently, but there is an issue if there's been big gaps in that employment history. So if you were out of work for a year or 6 months, they're going to want an explanation. And often if we can show that, maybe there was a temporary reason, you were injured or you were sick or you had to stay home for some reason, maybe you were a homemaker, and now you've returned to work and you're permanently back at work, then often if we can show that income is stabilized, then we're okay there, right? But so that's one of the things with employment history. The other thing to watch out for there is if you're changing employers, you want to make sure that you are not maybe so much the same line of work, but you are being paid in the same manner, right? Income sometimes can vary. Sometimes you're paid hourly, sometimes you're paid salary, sometimes you're a commission earner. And so you could have someone maybe who's worked for, a year or 2 years as an hourly employee, and then they decide to change, jobs. And now in the new job they're working at, they're 100% commission. Well, the problem there is all of a sudden I need to be able to verify how much commission you average. And typically they're going to need at least a year history. Often they're going to want a 2-year history to document that. So that can be where changing employment can be an issue. Overtime pay, tip pay, those kind of things, they get averaged typically over a 2-year history. And so if you've switched from being just like, oh, I was an hourly employee, but now they've changed, they switched me over and I'm, mostly tips, or I'm mostly, I have a lower wage, but I get more overtime. Those things can all affect the qualifying. So you'll likely want to check with your loan officer prior to making a switch like that if you're considering buying a home soon, right? Now, if you're going to a salary position, there's no problem there because we'll go by whatever the salary is, since that's a fixed amount you're going to get every month, right? And so that's kind of how the income works and how we'll be looking at income. It can vary because often the way that someone might calculate their own income is different than how the underwriter is going to calculate the income. And that's why it's important that, I, as the loan officer, review your pay stubs and W-2s and all those things. Because if, for example, I have someone who calls me and they say, hey, Ryan, I make $120,000, a year. And I'll say, okay, what do you do? And they'll say, I'm a valet parker. Immediately, I might say, okay, how much of that income is tips? And they'll say, oh, my base pay is only like, 20,000 a year or so, 24,000 a year on my hourly. And I'll say, okay, so out of that remaining 100,000, how much of those tips do you declare on your taxes? And that's where the problem starts, right? Because they don't realize it. They just look at it that they made 120,000 for the year, but the underwriter is going to look at it very differently, right? So, and then existing debt's a big one. Often when we talk about, trying or what steps to take to get ready to buy a home, people often think of savings first. They want to start saving for their down payment or those kind of things. And that is a very critical, like, early step you want to take. However, debt is usually the hurdle that's the hardest to get over. And that is often probably the first step that people should take, in the form of not over, committing themselves on debts that are going to linger around for a long time, especially when it comes to like car payments. Car payments are one of the biggest debts that get in the way of people being able to qualify for a home. Often they'll have, really big car payments. I've seen some people have, $1,400 car payments, $800 car payments, and it varies. If you're making enough money that payment's not a big deal, that's fine. But if you're, especially with first time home buyers, I'll see some people who, you're young, they're just starting out, they're in their early 20s, and they have a $1,200 car payment. And often that's a problem, and they can't, they're not making enough money to be able to absorb that and purchase a home. So, one of the things to always keep in mind is not overextending yourself with debt, especially, auto debt is a big one. Student loan debt can be another one. Often people think student loans aren't a major hurdle because they'll be in deferment or sometimes forbearance for a long time. And they think like, oh, I don't have to start paying those debts until, 5 years or 10 years from now. But the trouble is that, Fannie Mae and Freddie Mac and FHA, the government, they know that you're taking on a 30-year loan. And at some point during that 30-year loan, you're likely going to have to start repaying these student loans. So even though they might be deferred or in forbearance now, we often have to calculate some sort of payment and count it in your debt to income ratio. So it's something to keep in mind there when you're looking at those kind of things, right? And it's things that I'm sure a lot of people would have wished that someone had told them about it earlier when they were younger and taking out the student loans or buying their first car. So if you have kids and they're starting to approach that level, I'd say the same thing, like talk to them about like, hey, don't over encumber yourself with a large car payment. Like, get your house first and then you can turn around and get the car. Because I always say if you're in the market to get a car and to get a home, get the home first, because a mortgage underwriter will deny you. They'll say no. But if you go to a dealership, they will bend over backwards or find a way to get you into an auto loan, right? So those are the things to look out for there, right? And then when it comes to locking in the interest rate, when you're getting a mortgage rate, a loan, right? A lot of people will get pre-approved. And of course, at the time they get pre-approved, the rates may be a certain rate. But we can't lock in the interest rate until you actually get a home in contract. And like I said earlier, sometimes you go out looking that first weekend when you've got your pre-approval letter and you get in a contract right away. So I pre-approve you on Friday, and on Saturday you're in a contract, and on Monday I can lock in your rate. And that's great because usually there hasn't been that much of a change in the markets, right? But sometimes it doesn't work out that cleanly, and it might take you months. It might take you half the year. I've had people that sometimes kind of look for their perfect home, and it takes, 2 years or so to find it. And the markets can be completely different, right? At that time, rates can change. They can go up, they can go down, programs can change, all those things. So that's why a pre-approval letter is generally only good for 3 months. So you'll get pre-approved, that letter is good for 3 months, and 3 months from that, your credit report expires. We'll have to update your letter, which means we'd have to pull a new credit report if you're still interested in looking. Usually we won't do it automatically. We'll wait for you to reach out and tell us you want us to update the letter. But at that time, we can also look and say like, oh, when we first did your pre-approval a few months ago, the rates were 6. And now that we're looking, rates have increased some and they're at 7. So you can't quite get pre-approved for quite as much, or vice versa. Rates have gone down. If you were to get pre-approved now or lock in the rate now, you could qualify for more. So those are the kind of things you'll want to keep in mind to look out for, right? And the loan estimate, right? Now, there's a document called the official loan estimate. If people have been around for a while, you might remember there used to be a form called the good faith estimate. The government replaced the good faith estimate with a good faith estimate with the loan estimate during the housing recession. And it's basically the same. It's just changed a little bit where now there are certain fees that are on the loan estimate that once they're disclosed to you, they cannot change, right? Now, often, sometimes when people are getting pre-approved, they'll ask if they can get it in a loan estimate. And you can't at the time of pre-approval because we need to have a contract in line to be able to give you one. But we can give you like fee worksheets and different estimates that will give you a breakdown of what the cost will be, what the title fees, what we can estimate for taxes and insurance, all that. So you kind of have an idea of what kind of payment you're looking like and what kind of, funds to close you'll need, all that fun stuff that you have to know when you're looking to buy a house, right? So types of mortgages, right? There's all sorts of types of mortgages, and they can be a little overwhelming, right? Are we getting a fixed rate? Are we getting an adjustable? Are we getting an interest only? Is it Fannie Mae, Freddie Mac, FHA? It's all its own jargon, which can be completely confusing, right? So fixed rate mortgage is exactly what it is in the title. It's a fixed rate mortgage. The interest rate that is on that loan is going to be the same from the day you take that loan out until you pay off that loan. The rate doesn't change. Your payment essentially doesn't change, but when they talk about your payment not changing, they're talking about the principal and interest payment of the loan. Your taxes and insurance, which often are included in your payment, those can change. So, your taxes can go up year to year. Your insurance company can raise the insurance on your home year to year. And so sometimes you'll see small adjustments in your payment, but the principal and interest portion of your payment won't change during a time that you have a fixed rate loan, right? Now you have your adjustable rate loans, right? And adjustable rate loans, they have a pretty bad rap, especially after what happened during the housing recession. A lot of that was caused because people were getting into adjustable rate loans and didn't quite understand the terms or how they worked, or they were told that, like, oh, don't worry, you can just refinance out of it when the time comes, and it's not a big deal. But it's important to keep in mind, how those adjustments happen, when they happen, and what are the maximum that the rates can adjust to. Can the rate go down? All those kind of things that come in place. Adjustable rate mortgages are done a lot differently now than they were done prior to the housing recession. Now, when we do an adjustable rate mortgage, we have to qualify the borrower with the rate based on the first adjustments max. So if you were to get approved for a rate on a adjustable rate mortgage that had a 5% rate to start, but then the max you could adjust 5 years later maybe was 2%, we would have to qualify you based on those two combined, which would be 7%. And that kind of gives you a little bit more of a cushion to know that you'll be okay when that rate does start to adjust, right? Some of the benefits of an adjustable rate mortgage is that, of course, the interest rate is generally lower initially, but can increase later. So it's a good loan for someone who maybe doesn't plan to be in the home for a long time. Maybe you're thinking, max, I'm going to be in this, home for 4 years. So you might opt to do a 5-year adjustable rate because you plan to sell the home. And then in those initial years, you can get, a bit of savings from having that lower rate. The other thing is that, if the rate goes up, you have to be cognizant about your ability to afford that increased mortgage payment. So it's things you'll want to have in mind. And of course, nowadays, the forms and even the loan estimate that goes out will have a breakdown of the best case and worst case scenario that could happen on each adjustment. And it kind of spells it out where the good faith estimate didn't used to cover any of that. So you'll be able to see it in writing and know if that loan works for you, right? Interest only mortgages are kind of rare. They still exist, but you don't really see people doing them. And it's basically a type of mortgage where it allowed you to pay only the interest on the loan. You didn't have to pay any principal. So essentially the principal was never coming down. And a lot of them had interest only periods during the loan. So much like an ARM, they might have had that if you took out a 30-year fixed, there was an option to have like the first 10 years be interest only. So that first 10 years, you could just be making the interest only payment on that 30-year fixed rate loan. But of course, at the end of year 10, they would fully amortize the loan over the remaining years. And all of a sudden the loan, the payment becomes what the 20-year payment would have been, because now you've only got 20 years remaining in the term. They amortize the full principal, especially if you haven't paid any principal down, on your own volition. Now that gets amortized over the 20 years, and that payment can jump significantly. So that's the thing you'll want to keep in mind there, is that it can vary. They also offer interest-only mortgages on adjustable rate loans, and that's kind of like double jeopardy, because now not only do you have the interest-only portion that can jump up on you when it gets fully amortized, but you have the adjustable rate, portion that can change too, and the rate goes up there, right? So let's see. Let's go on to our next stage here. So mortgage payment components, right? Like, what is your mortgage payment made up of? And this is a little bit what I was talking about, right? You've got your principal and the interest. The principal, of course, is what's going towards paying down the balance of your loan. At the beginning of your loan, it's going to be a very small amount of principal, and the majority of your payment is going to be interest. As time goes on, though, the amount of interest will decrease while the amount of principal increases. And usually it's around, like year 15 that you start to pay, more principal than you're paying interest. So that's one of the reasons that we'll often say, if you can, it's good to pay one extra payment a year, because doing that will apply that entire payment to principal, and and it can cut on average on your 30-year loan, it can cut approximately 8 years from your average 30-year loan if you make one extra principal payment a year. So that kind of helps whenever you can pay a little bit extra principal, right? The other things that make up your mortgage payment, of course, are your escrow account. So in here, you'll have your property taxes, your homeowner's insurance, and if you require it, your mortgage insurance, right? The property taxes are set by the county. You can kind of look around, and you can even, if you have an address that you're thinking about buying, you can go to the county treasurer's website, type in that address, and it'll show you what those taxes are, right? Your homeowner's insurance is determined by, whatever insurance company you get. And as a lender, we're kind of indifferent as to what homeowner's insurance company you go with. You can pick any company. All we really care about is that you have sufficient coverage to, fix the home should something happen, if there's a flood, if there's a fire, anything catastrophic, that the insurance covers, those things to be repaired. You want to make sure you keep up with your homeowner's insurance. If for whatever reason your insurance coverage should lapse, the mortgage company can put what's called forced place coverage on your loan. And a lot of times that forced place coverage is significantly higher than what you would get on your own. And it can make your payments shoot up. And sometimes people will be like, my payment went way higher and I don't understand what happened. Often it's because they didn't get proof of evidence of insurance, because the lender will check in throughout the time that you have your loan to make sure your insurance is in place. So you'll want to make sure that's there, right? And with your homeowner's insurance, if you're buying a home, like your mortgage insurance, if you're buying a home and you're using a conventional loan and you don't put 20% down, you've got to pay mortgage insurance. Now, mortgage insurance gets a bad rap often because people are like, oh, I have to pay this mortgage insurance and it doesn't really do anything for me. And it just protects the lender and that kind of thing. And that's somewhat true, but at the same time, if you consider the origins of mortgage insurance, right? Mortgage insurance was kind of created through FHA. FDR created it after the Great Depression. A lot of banks at the time wouldn't make home loans without buyers putting down, significant down payments of like 50% or more. And so to make it easier for people to be able to buy a home, they created FHA to insure part of the home for the banks. And that allowed for buyers to be able to buy homes without having to make big down payments of 20% or 50%. And nowadays, you can buy a house with an FHA loan using 3.5% down, or even a conventional loan using 3% down. And the reason that's possible is because of mortgage insurance. So why often people say like, oh, mortgage insurance doesn't really do anything for me and why do I have to pay it? The reason is it lets you buy a home without having to put a large amount of down payment, right? On an FHA loan, the mortgage insurance is a little bit different than it is on conventional. They charge you an upfront amount and a monthly amount. And even if you put 20% down on an FHA loan, you still have to pay the mortgage insurance. And often, if you're doing like the minimum down on an FHA loan, the mortgage insurance is for the life of the loan. It can't be removed, at least under the current rule set. Years ago, prior to the housing recession, you could remove it, but they changed the rules and they haven't changed it back yet. So right now, it's usually life of loan for an FHA loan. The ways to get out of it is A, you can refinance that FHA loan into a conventional. And if you have that 20% equity position at that time, you don't have to have mortgage insurance. So that's kind of how that works. And one note on property taxes, right? When you're looking around for a home to buy, you'll have to keep in mind that the newer the home, the higher the taxes are. So often you might see some, new home builders, and they're often showing that they have a much lower interest rate. They might be offering like a 3-2-1 buy down, where the first year the rate's 4, and then the second year the rate's 3, and then 5, and then it goes up to 6, and those kind of things. But the one thing they often don't tell you is that the taxes are much higher on a new build than they are on an existing resale home. So those are things you'll want to keep in mind. It's almost like when you buy a new car, like the registration's higher than when you buy an older car. And it's the same thing for the taxes on a home, right? So let's go to our next slide here. So choosing a real estate agent. So this is a fun one, right? Once you get pre-approved, you'll want to get together with a realtor. They're going to help you go out there and find a home. You'll tell them what you're looking for. You want a home in this area or this zip code, 2-story, 1-story. Does it have a pool? How many bedrooms does it have? how many bathrooms, 3-car garage, all that fun stuff. Maybe you're looking for a home that's in a particular school district, right? It could be all sorts of, all sorts of things that come up in there. Maybe you're looking for a home that's in a senior community, maybe you want a home that's not in an HOA. This is where your real estate agent's going to come in. He's going to type all that into a computer. He's going to, find some homes that look good for you. You're going to go out, look at those homes, see what you like, and then they're going to negotiate the contract with you. They're going to make the offer with the seller. They'll submit it to the seller's agent. They'll go back and forth. Maybe the seller accepts it. Maybe they counter offer, and you'll go back and forth, right? You may ask, family and friends for referrals for realtors they might have used. You can ask your lender too. Is there a realtor that regularly works with the lender? Are they familiar with the lender's programs? Or if you're using a particular, special program like a grant program, you may want a realtor who's familiar with that. There are some down payment assistance programs that the lender and the realtor have to be approved and on a list for that program. So, there might be scenarios like that where maybe you have a realtor you want to use, but they're not on the particular program you're wanting to use for your loan, right? You might want to find an agent that's familiar with the area you're looking at, right? If you're looking for an agent in Summerlin or a home in Summerlin, you want an agent that's familiar with the area. If there's an agent who doesn't really work in Summerlin, that might not work in your best interest, right? Comparison shop. See, if you like this realtor more than the other realtor, are they going to offer any special assistance that maybe another realtor wouldn't? Some realtors will give you a rebate back on their commission. Some realtors will help you with gathering loan documents and the loan process and things like that, right? You want to avoid using the seller's agent, right? Oftentimes you might be driving around and you'll see a for sale sign up and it has a phone number on there. Well, that's the seller's realtor's phone number. And of course, the seller's realtor already has a fiduciary responsibility to try to generate as much profit for the seller as they can. So reaching out to them and asking them to represent you is kind of a conflict of interest. It's kind of like if you were going to court to get divorced, you wouldn't want to use the same lawyer that your spouse is using. It could be a conflict of interest there, and you couldn't really be certain that they're representing you to the best of their ability, right? And then in terms of, how to go about finding one, you can contact local real estate brokerages, see if they can give you referrals for agents. In terms of finding an agent, sometimes it's just a personality thing. Some people click together better than others. So you'll want to talk to a few different ones to see kind of what suits you best, right? And then types of homes, right? So there's all sorts of different types of homes, right? You've got your single family residence, townhomes, condominiums, duplex or multifamily, right? Co-op homes, cooperative, manufactured housing, planned unit development, which we'll usually use the acronym of PUD for. So have you ever heard someone say, oh, it's a PUD? It's a planned unit development. And basically what that means, right? Planned unit development just means it has an HOA. That's basically it, right? Now, single family residence, of course, is a single family residence. We've got some pictures here, right? There's if you can see my pointer, this first picture is a single family residence. This second one looks like a single family residence. However, this third one, is more than likely a townhouse or condominium build, more than likely a condominium. If you're back east, it could be a co-op, right? So a townhouse and a condominium, sometimes there's slight differences. People wonder what the differences are between those two. And often the big difference is that on a condominium, you don't own the land that the condominium sits on. You just have the structure and your particular unit. On a townhome, usually the land that it sits on is part of your ownership, right? Co-ops are a little bit different. They're usually, we see them a lot back east, New York and whatnot. And that's usually like a cooperative building where if you wanted to buy a unit in that building, the rest of the co-op would have to approve you to purchase a unit in that building. So we don't really see them here, but that's kind of what a co-op is. The other difference between condos and townhouses is the financing on them, right? If you wanted to get a loan for a condominium, it can be harder to get a loan on than it is for a townhome, right? So for example, FHA can be very hard to find condos that are approved by FHA. FHA actually has an approved condo list, And, well, usually if someone tells me, hey, I'm looking to get a condo, but I want to use an FHA loan, the first thing I'll usually say is, okay, give me the zip code you're looking in. And then I'll go to that website and I'll type in the zip code and I'll say, like, there are no condos in that zip code that are approved by FHA right now. And it's kind of an issue. It can be hard to find a FHA approved condo, community. There are some out there, but it is a little bit of a needle in a haystack. Even with conventional loans, condominium financing can be a little trickier. The condo has to meet certain criteria. Some of that is like owner, renter, split. So like if 51% of the units aren't occupied by owners, they're occupied by renters, then that can be a problem for financing. If any one entity or person owns more than like 20% of the total units in the community, that can also be a problem for financing, right? There's different little things. If there's a litigation against the HOA, things like that, sometimes they can be a problem. Sometimes, though, on a conventional, even if those problems arise, depending on what they are, you can get what's called a non-conforming condominium loan. And in that scenario, we can still do the loan, but it's not going to be your traditional like Fannie Mae, Freddie Mac financing, right? And then from there, let's talk about, duplex or multifamily homes. This is a really good option that doesn't come up often. A lot of people don't think about it. It's a great option for first-time home buyers or, young couples buying their first home, especially if you're struggling with debt-to-income ratio issues, because you can count the rent from the other units that you're not going to occupy as income to qualify. So, if you're looking at a duplex, you can count the rent from the other income to help you qualify. If you have a fourplex, you can count the rent from the other 3 units to qualify, right? The other, type of housing is manufactured housing. We do offer loans on manufactured housing. You can do conventional financing on those. They do have to be converted to real property, and they do have to be attached to a permanent foundation. You can't, get a manufactured home on something that's in a mobile home park or anything like that, right? So there's that issue. There's also other things that the condo can't be, in the manufactured home can't be older than a certain year, you know what I mean? So there's kind of issues. And then let's see what else we have here. Let's go to our next slide, if my computer will cooperate. And so considering what is affordable, right? It advanced one slide too many. Let me back up. I think I had a little lag in my computer there. Let's see. Let's go back. Okay, so consider what is affordable, right? A house you can't afford can bring a lot of stress. You don't want to be what a lot of people refer to as being house poor, right? So you want to make sure that whatever you buy fits in your budget. If you like to travel, you want to leave room in your budget to travel. If you want to, be able to go out to dinner often, you want to make sure that you have room to go out for dinner in your budget. So create a budget before you start shopping to keep those things in mind when you're looking for a home, right? Calculate all the costs associated with your house, because you won't just have your loan payment, you won't just have property taxes and your homeowner's insurance and all that, but you're going to have maintenance, right? You're going to have your HOA dues. There are things that, as a renter, if you rented or if you lived at home with family before buying, that you're going to have to keep in mind, like, your air conditioner could go out and that could be a big expense. Your water heater, your garage unit, your garage door opener can break. There's all sorts of little things like that that you'll have to keep in mind. Plumbing issues, electrical issues, all that. So those are things you'll want to, factor in, right? And then let's see. On our next page, we have, decide what features you want, right? And this comes up to a lot of like what you want versus what you need, right? There's, you want to factor in like, do I want, a certain number of bedrooms? Do I need a certain number of bathrooms, right? Are you looking at a new construction home? Is it a fixer upper? And if it's a fixer upper, keep in mind that the house still has to be livable, right? You know what I mean? You can have cosmetic issues that you need to fix, like flooring and paint and, cabinetry, little things like that. But of course, if the house isn't livable, we're not going to be able to make a loan on that, right? What kind of size do you want? Is there a certain square footage you need? Is there, do you want it a 1-story? Do you want a 2-story? What about the layout? Do you want some people want a master bedroom downstairs. One of the things we see often now is like a next gen suite where maybe you want your elderly parents to live with you, or maybe you have college age children that are living with you and you want them to have their own space, their own entrance so they can kind of come and go at their own free will, right? Outdoor space. Do you want a big yard? Do you want a small yard? Do you want a patio? Is a yard not an important issue at all? Do you want a pool? Things like that, right? What about location? Those are all things you want to consider when you're looking at, different homes and whatnot, right? And next slide here. My computer's lagging a little bit. And I think, let's see. Sorry, give me just a second while my computer decides to cooperate. Oh. Sorry, I can't seem to advance the slide. Give me just a second here. There we go. Okay, so we're on to the next slide here, which is number 15. And okay, so the home search process, right? Um, you want to, request an MLS home listing from the real estate agent, right? The real estate agent will, type everything in. They'll pull up all the MLS, listings for homes that match your criteria, right? You want to avoid being distracted by things that are easy to change, right? If you walk into a home and you don't quite like the flooring, that's easy to change. You could put in tile or wood or laminate or whatever you might like, right? Um, paint colors also another thing that's easy to change, right? Take pictures when you go to the house, fill out like a little checklist when you're at each one, because later on it can be hard to remember which house had which features, right? Did this house have that really nice bathroom? Did this house have a really great patio area to relax in? Did this other house, which one was the house that had the upgraded kitchen? Those are all the things you might not remember, so it doesn't hurt to take pictures while you're there, make a checklist, right? Consider things like commute times and local schools, right? How long does it take you to get to work? How long does it take to get to your school, your children's school? What schools are they zoned for? All those kind of fun things. And then this is a big one sometimes people don't think about, but visit the home more than once when you're making an offer, and visit it at different times, right? You might go to see the home on the weekend when things are kind of relaxed and maybe there's not a lot of stuff going on, and you might not notice, issues that might present themselves later. Like maybe you go and visit the home during the week in the middle of the day, and you notice that, someone's, home during the day, and maybe they like to work on their motorcycle and they're revving the engine in their garage or doing whatever it might be. And you might not like that, right? So you want to consider things like that, you might have a couple that, maybe later on at night, they exercise in their garage and they're noisy and they got the garage open or whatever it might be. So visiting the home at different times is a good consideration. Are you near a school? Does the foot traffic of the school starting and stopping affect, noise and traffic around your neighborhood? Things like that you'll want to take in consideration, right? And also the association. You'll want to, look into the guidelines that they have. What are those guidelines? Do they work with what you're looking to do or not? I mentioned the gentleman with the motorcycle in the garage because I once had a loan for a gentleman and he was purchasing a home, and he liked to work on motorcycles. And one of the rules they had is that he wasn't allowed to do that in his garage, and so he canceled that transaction and bought another home. So things like that to keep in mind when you're looking around. Components of your offer. So let's say you found the house, you want to make an offer on it. The agent's going to draw up that offer and what it looks like, right? So what's the first important thing on the offer? Of course, the purchase price, right? How much is that purchase price going to be? What are you willing to offer? What are they asking? This is where the big part of the negotiations going to come into play. Then you've got the closing date. How long is it going to take you to close? Traditionally, when you make an offer on a house, it takes 30 days to close from when they accept your offer to when we close. Sometimes, though, you might ask for an extended closing for some reason. Maybe the seller needs extra time after the home closes to move out because they're buying another home or whatever it might be. In that scenario, they might do a rent back where they'll close on the home and you'll officially be the owner, but maybe they'll rent it back from you for a week or two, right? Or maybe you're selling your home and you need a little extra time to get that deal closed. So instead of a 30-day escrow, maybe you'll ask for a 45-day escrow, right? That's what we would refer to as a contingent offer, right? So what's the offer's expiration date? If you make the offer on the house, you're going to usually give them X amount of time to respond. 24 hours, sometimes, a day or two, just depending. You want them to look over the offer, consider it. Often a seller, depending on the market, if it's a buyer's market, they'll probably respond a lot faster. If it's a seller's market, they might wait to collect a few offers and then maybe put out a request for the highest and best offer from everyone who's interested in the house, and then just pick the highest one they get, right? Concessions, right? You might ask for the seller to pay certain things, right? The seller, traditionally, there's items they pay for kind of customarily in the contracts here in Las Vegas. Those are like the transfer tax, the owner's title policy, and they usually pay a half of the escrow fee. And that's customary. Doesn't mean that it always happens, but 9 times out of 10, they're covering those fees minimally. And those are their fees. Those aren't fees they're paying for you, right? You might ask them to pay your closing costs, right? So, sometimes you might ask for a flat amount, $5,000 towards your costs. Sometimes you might ask for a percentage, 1% of the purchase price, whatever it might be. If you're doing a conventional loan, usually the max they can contribute is 3% of the purchase price to go towards your cost, right? If the amount exceeds your actual cost, the difference can't go back to the buyer and it can't go towards your down payment. Usually, either we try to find a way to use it up, like buying down the interest rate so you get a better rate using those credits, or those funds get left on the table, right? Sometimes they can pay for HOA dues, maybe cover a few months out, sometimes taxes. There's a couple things like that they could do, right? Other items might be inclusions, right? Personal property that gets left by the seller. Let's say you go buy, you go to buy a home and you make an offer on it, and maybe this home has a nice pool table and you like that pool table. And so you ask the seller, hey, I want to buy your house for this price, but would you consider leaving that pool table? You can do that, but doing so complicates the offer because now that pool table is seen as an inducement of sale. And the underwriter is going to want to know what the value of that pool table is and all those things. So it becomes a little bit trickier. Often, if you're going to do something like that, where maybe you want something that's in the house, you'll have your realtor handle that outside the escrow, like not in the contract or any of those things. Or sometimes you run into a same scenario. Let's say there's a great pool table. It's a really nice old pool table. Maybe it has an old school like marble slate in it that's super heavy. And the seller might say, you know what? I don't want to move that pool table. It's downstairs or it's upstairs in my loft or den and it's super heavy and I don't want to move it up the stairs or down the stairs. So you can just have it. In that case, you're okay because I'll usually put some verbiage in there that says the pool table's just being left at the owner's convenience because they don't want to have to move it. We see that often with like spas in the backyard or any like super heavy equipment. And contingencies, right? Like when you make your offer, there are some contingencies in there, right? And there's usually 3 contingencies, but we could say there's 4, right? The first one is what we call your due diligence contingency, and that includes your home inspection. That's often, 10 days, 7 days, just depends on what you agree upon. But this is the time period that you're going to have to get a home inspector out to the house. They're going to look over it. They're going to check the electrical panels. They're going to check the faucets, the outlets, the air conditioner, the gas stove. They're going to look at everything. They go over everything, and they're going to give you a detailed report on every little thing. And they will mark every little thing. Like if they see a little spot in the bathroom that maybe the drywall got went, once and it's stained, they're going to take a picture of it and point at it with an arrow and be like, there's a water spot here. I don't know what that means, but it's here. I don't know if there's a leak. I don't know if there's this and that. So you'll definitely want to get those done. We don't require a home inspection as the lender, but I highly recommend you get one done unless you're familiar with the home already, like you're buying it from family, or maybe you've been renting it from the landlord for a few years, and now you're going to buy the home from the landlord, so you know what's involved or what the house has. But even then, it can't hurt. Home inspections usually a couple $100, $300 or so, right? This is also the time period, this due diligence time period, is when you'll want to get the HOA rules. They're referred to as the CCNRs, right? You'll want to get the official rules from the HOA and look over it and make sure there isn't anything in there that is going to be a problem for you, right? That you don't like, or you don't want to live in this community because of these rules. And so that's the due diligence period, right? The next contingency you have is the appraisal contingency, right? And this is traditionally about 14 days from when you go into contract. This one states that we're going to get an appraisal on the house, and we want to make sure that the home is worth at least the purchase price of, that you're offering on it. So if you offer $400,000 on the home to buy it, and we get an appraisal done, we want to make sure that appraisal comes in at least at 400. If it comes in lower, then there's a couple different options that come up, right? Option one is you go back to the seller and renegotiate. And, he could just agree to lower the purchase price. So if you asked for, let's say the purchase price was 400 and the house appraised for 390, you could say, hey, it only appraised for 390. I'd like to renegotiate this. And 9 times out of 10, they just bring the value down. They'll bring it down to 390, and that's, all that ends well there. But sometimes maybe if they've agreed to pay, 5,000 towards your closing cost or something, they might say, okay, we'll lower the price at 390, but we're not going to pay that 5,000 towards your cost. This is where the negotiation happens again. The realtors will get involved, and they'll go back and forth on what's fair. If that happens, sometimes your agent might come back and say, hey, my buyers are first-time home buyers. They have enough for the down payment, but if you don't pay this 10,000 towards closing, they can't close. That might change the seller's opinion. The seller might still dig their heels in and say, nope, we'll go down to 390, but we're not paying that cost anymore. So it just depends, right? The other option that can happen, which happens sometimes, especially in a seller's market, is that you as the buyer might decide to pay the difference. I'm I wanted the house for 400, it appraised for 390, but I am okay with paying the difference. And in that case, you pay that 10,000 above and beyond your normal down payment and your closing costs and whatnot to go towards that, right? The other option that can arise out of this is that you and the seller can't agree. He won't come down in price. You won't pay the difference. You won't split the difference, or maybe he says, hey, I'll come down 5. If you come up 5, you guys can't agree with it, you cancel the transaction. And at that point, you walk away and you go find a new home. The earnest money deposit you put down when you made the offer on the home gets refunded to you as long as you're within your appraisal contingency, right? But you're out the cost of your home inspection and the cost of the appraisal. So usually you kind of want to look out for it. Often it's good to know, because if you are buying a home for 400 and it appraises for $10,000 less, it might not be too bad, but it appraises for $50,000 less or more, the money you spent on the inspection, on the appraisal, was well worth it, because you didn't buy a house that was, $50,000 under what you were offering, right? And your other contingency then is your loan contingency or your financing contingency. This is usually a 21-day contingency. It can vary, of course. It's all negotiable with your seller. But generally what this means is by the end of that 21 days, we want to have a clear to close approval from the underwriter. So at this point, we've got the appraisal, we've got the title report from the title company, we have all your pay stubs, your tax returns, whatever we might need for the loan, and the underwriters reviewed all of it, and she has said this loan is cleared to close, right? Now, it may not be that simple sometimes. Sometimes we'll submit the loan to the underwriter, and the underwriter might come back and ask for conditions. If she asks for conditions, then we get back together with the buyer. We say, hey, the underwriter wants an extra pay stub or an extra bank statement, or there was a deposit on your bank statement that she wants to know what that was or where that money came from because it just says cash, right? We get whatever that is, we give it back to the underwriter, and then she signs off on it. And now we have clear to close, and now you've met your financing or your lending contingency. And of course, the final contingency is the closing date. If you had 30 days to close, now's when you're going to reach that closing period, and we want to make sure we can close that time. Now, if for any reason something comes up that delays any of these, like maybe you had a 14-day appraisal contingency, and maybe you're buying a unique home that is on a big piece of property or has unique construction, the appraiser might take a little longer to appraise that. He might say like, hey, I need to find comps because this property is unique. It's going to take me a little bit longer. I'm going to need 17 days before I can get it back, or any of that things. In those scenarios, we just get an extension. We request an extension from the seller, and we say, because of this reason or that reason, we're going to need an extension of this, and that still protects the earnest money deposit during that time period. All right, so let's go to the next slide. Hopefully we have no slide problems, and we did it. So let's see. So you've made the offer, right? The real estate agent presents the offer to the seller. When you do that, there's usually an earnest money deposit that's agreed upon. That can range, depending on the seller, anywhere from like $500 to $10,000. I had a property once that I was looking at. I was trying to buy a home for my mom that was like 2 houses away from me. And, they had an offer on the property already. And I was like, well, maybe I can meet that offer. Like, what are they offering? And they told me what the offer was. And I was like, hey, I'll go 10,000 over that offer. But then they said, well, the other issue is that the offer we have now has also made an $80,000 earnest money deposit on the house already. And I was like, well, I'm not going to do that. I'm not going to give you $80,000 up front. So sometimes that stuff happens, right? And basically the earnest money deposit is just letting the seller know that you are serious about buying the home, right? So, it can range anywhere from, like I said, a couple of hundred to a couple thousand. You do not give that money directly to the seller. The money goes to the title company, and they hold it until closing, right? So when you make your offer, they're going to accept. They might reject the offer. They might counter. The seller will let you know. Once the offer is accepted, it is binding, right? So at that time, they can't take any other offers or decide they want to go with someone else because you made them a higher offer or any of those things, right? Depending on where it's at. Now, let's say you miss one of those contingencies and the seller didn't extend that contingency, then at that point, they could cancel the transaction and go with someone else. You know what I mean? So that's something to kind of keep in mind there. In regards to the appraisal, because we get this question a lot sometimes, is if the appraisal comes in under what you offered, we talked about the stuff that can happen. Well, what happens if you made an offer to buy the home at 400 and maybe the appraisal now comes in at 450? Well, that changes nothing. The seller cannot adjust the purchase price or cancel the deal or anything because the appraisal came in higher. And generally, we don't give the appraisal to the seller. We just give it to the buyer. But that's something to keep in mind because sometimes people ask, like, oh, can they change this? Or, how does that work out? So that's usually what you're looking at there, right? So now we enter what's called like the pre-closing period, right? So now we're the loan is processing. We're getting ready to close. We're doing everything we do. You do your home inspection. You're gonna, check in with your lender. Your lender's gonna check in with you, and they're gonna see what what you might still need, what steps they're in. Is there any hurdle that's presenting itself? What's coming up during that time period? You want to look around for homeowners insurance. See who it is you might like to use. We are indifferent. Like I said earlier, you can pick anybody. A lot of people will start their search with their current auto insurance company. Since they already have insurance with them, sometimes you'll bundle it in. You can get a little bit better of a deal on a bundle. Sometimes if you're renting, you might check with the company that carries your renter's policy. And we can make suggestions. You can shop around and look. But once you let us know who you want to use, then we'll get that all set up at the end, right? And then, of course, during the process, you want to avoid taking on additional debt. Right? You don't want to open any new accounts. You definitely don't want to go out and buy a new car. Please don't do that. I've had people do it where it created huge problems, right? Avoid any of that stuff. Avoid making any big purchases, even in cash, right? Check with your loan officer if you're thinking of that. In some scenarios, it may not be a big issue if you have a lot of cash in hand. Like if you have, $200,000 in cash and you only need 50,000 to close, and maybe you want to buy something for 10 or 20,000, that could work. But check with your loan officer, because even then, sometimes your loan might require reserves. And that is not funds that you're going to put down. It's not your down payment. It's not closing costs. But sometimes to get the loan approved, you might need to show that you have 6 months worth of payments in reserve or 4 months worth of payments in reserve. And sometimes that's what's helping you get approved. And if you spend a certain portion of that extra money that you didn't think you needed, then that can create an issue because now you no longer have your reserves, right? So let's see. If two or more owners are going to be on the title, you want to decide how you're going to take title. And this could be, a lot of people don't think this is a big issue, and it's really not. But depending on your scenario, you might want to investigate it a little bit closer. And the best place to talk to there will be the title company. They'll be the ones that kind of, can advise you and inform you what might be a good way for you to hold title. The most common way that people take title is as joint tenants. Usually it's going to be, John Smith, married man, with Jane Doe, married woman, as joint tenants, and that's how they might take title. But there are different forms you might consider. One of the common ones is tenancy in common, right? And that can be popular with blended families, right? If you have spouse one was married previously and has children from his previous marriage, and spouse two was married previously and they have children from the previous marriage, and then they get married and buy a home together in joint tenancy, right? If you do, if you take title as joint tenants, often when one of the owners passes away, their ownership passes to the surviving owner, and now they have 100% ownership. But in a blended family scenario like this, parent might consider that if I pass away, I don't necessarily want my equity or my ownership in the house to pass to my spouse. I want my ownership to pass to my children. And that can be important. You never know. You hear stories sometimes where, husband and new husband and your wife are living together, and the husband has a heart attack, and now new wife tells his children that they can get out. They can't live there anymore, or vice versa. So you want to, and people will do those kind of things to protect the interests of their family, depending on, children's ages or what their scenarios might be. There's also taking titles and trust and different things like that. So that's all stuff you want to look into. And the best place to kind of ask is the title company when you're doing that, right? So then once we've done everything, you've got your clear to close, you're ready to wrap everything up, you're going to do your final property walkthrough. And this is important because in 30 days from when you bought the house to when you're ready to close, all sorts of things can happen, right? Sometimes it's minor, the owners were moving out, the seller was moving out, and as they were carrying furniture out, maybe they accidentally put a small hole in the drywall with a heavy cabinet or something. If you do your final inspection, you'll say like, hey, can you fix that before we take ownership, before we close? And oftentimes they're going to. But you also want to make sure, because sometimes you'll have a property that's vacant and no one's in the property. Maybe the owner lives in a different state and they moved and now they're selling their trailing house that they had while they lived there. Sometimes if no one's been in a house for 30 days, all sorts of things can happen. I've had, one of the reasons I always tell people, if you are in contract and you have 30 days to close, do not tell your tenant, do not put in your 30-day tenant notice to your landlord that you're going to move out, because you don't know what's going to happen. Don't schedule movers, don't schedule time off. I usually say wait until you have your keys in hand to do any of that, because in the 26 years I've been doing mortgages, I've seen all sorts of things happen. Pipe burst. Sometimes you might have like a flex line in a bathroom, gets a small, little pinprick hole in it, but it's been leaking slowly for 20 days now, and you've got 3 inches of standing water in the house, right? That's a problem. And when you do your final walkthrough, and you discover that, now you can be like, I don't want this house, or let's get this repaired. Let's get, water remediation in here. Let's do all that. But of course, if you told your landlord, hey, we're going to move out at the end of the month, and now it's the end of the month and you can't move in because we can't close on the house because there's this issue with the water, now you've got nowhere to live, right? So usually you want to wait on those things, and you want to do this property inspection to make sure there aren't any issues that arise at the last minute. During the housing recession, I remember I had a young borrower, and when he went to close, he did his walkthrough, and someone had stolen the air conditioner from the backyard. They just came in and took the whole unit, and so odd things can happen, right? Murphy's Law. So now we go on to the closing, right? So now your mortgage is finalized. The title of the home is transferred to you, right? 3 days prior to the closing, you're going to get the closing disclosure. It looks a lot like that official loan estimate that started out the whole transaction, except it's the final version of it. It's like the boss version of it, right? It's evolved into the final form. And the closing disclosure is going to have essentially what you can expect to see when you go to the title company and you sign all the closing papers there. That way there's no surprises, and you'll get this form 3 days prior to closing. It's going to have how much you need for closing, the payment, all those details just updated from the loan estimate. And a lot of the costs that are on there can't change from that official loan estimate. So if you do see a big difference, you go like, wait a minute, why did these fees change, right? And they'll go over to you. Technically, by law, there's a lot of fees on there that aren't allowed to change, right? Things that are allowed to change are like taxes, insurance, days of interest, and not so much the amount, right? Like the taxes of the home are the taxes of the home. The insurance, of course, is whatever insurance company you picked, what the premium is. That's not really going to change. But what might change is like the number of days of interest we need to collect, or the number of months of taxes we might have to collect up front. And that just depends on when you're scheduled to close. Maybe you were scheduled to close at the end of May, but something came up where there was an issue at the last minute and the closing rolled into the first part of June. In that scenario, you might need an extra month of taxes, or instead of, if you close at the end of the month, like if you close like May 25th, you might have only had 5 or 6 days of interest there, right? But if it rolls into like June 1st, you're going to have 30 days of interest. So it changes, but the other things that might change is when your first payment, is due. If you had closed on your loan in May, you always skip a payment on the month after you close. So in this hypothetical scenario, if you closed in May, you would skip June and your first payment would be due July 1st. But if you close in June, you would skip July and your first payment is due in August. So that's kind of the way it works. And some people look at it as, oh, if I close at the beginning of the month, I get to skip 2 months of payments. And if I close at the end of the month, I get to skip 1 month of payment. But either way, it's kind of 6 of one or half a dozen of the other, because you're going to pay the interest or the taxes or whatever you need to set everything up correctly, right? And then prepare to sign. You'll make an appointment with the title company. They'll usually reach out. Most signings take place in person. You'll go to the title company, you'll sign there. There'll be a notary there to notarize everything that's needed and all those things. But you can also opt to have a mobile notary meet you. They can meet you after hours. They can meet you at your workplace. I've had mobile notaries go to a hospital, after maybe like a child was born, and do a signing there. I've had mobile notaries go out of state while people were on vacation. I even had a mobile notary once meet someone that was on a cruise. I believe they were in Thailand, and everything had to be signed at the embassy, but it's been done. So that stuff can happen if you need to. If you do elect to use a mobile notary, there often is an extra charge. It's usually about $200 or so to have the mobile notary meet you, right? The items you're going to sign at the closing is going to be the note. The mortgage note's going to spell out the details of the loan, the loan amount, what the term is, how many years is it for, what that principal and interest payment is, that kind of thing. The deed is going to spell out the ownership of the parcel of property and like what riders you might have. Is it an HOA? Is it a condominium? Those kind of things. You'll have the riders that attach that and explain this is the deed to the property you own, right? The closing disclosure is going to be there. There'll be other affidavits, name affidavits, all sorts of fun stuff like that, right? And then let's go to the next sign. So you're going to see your closing cost, will all be there. A lot of this you would have seen on the loan estimate, but you'll have the loan origination fee, right? That's what the lender charges to do the loan for you. At the credit union, we charge $4.95. And then we use a contract underwriting company. They charge us $9.95 per file for underwriting, right? Points, or if you want to buy down the interest rate, right? So you might pay points to get a lower rate. Sometimes some programs have points associated with them, like if you're doing an investment loan or if you're doing a specialty program or things like that, right? title fees. The title company's fees are going to be on there. There's some of the biggest fees in the transaction. A lot of times they make up like a third of the fees. The appraisal is usually about $550. It can vary depending if you're having a, is it a rental property you're buying? And if it's so, are we getting a rental schedule to show us what the fair market rent is? Is it a unique property? Is the property in a more rural location where the appraiser has to drive out? That can all change the cost of the appraisal. The appraisers are assigned randomly. So often we don't know who's going to do the appraisal until it's actually been assigned and they do it, right? A survey, the title company might have a survey done. Often they will inspect the house themselves. They'll have someone drive by just to make sure there isn't any work ongoing or being done on the property while you're closing. Because, of course, one of the things the title company is making sure is that you're not going to have any liens from the previous owner passed on to you. And mechanics liens are usually the biggest ones that appear. Maybe there was a dispute and the previous seller didn't, pay a contractor or a plumber or something. So that person might put a mechanics lien on there. Your title insurance from the title company is going to protect you against that, right? And that's kind of why they'll do the surveys. The recording fees are the county's recording fees, right? You'll want to make sure, that it gets recorded, and they always do. The title company takes care of that. That's kind of where they officially record the owner and the closing of the loan and all those things. One of the things to keep in mind if you're doing a refinance is that if you add an extra party onto the title who's not a direct family member, like a mom or dad or something like that, the title the county will sometimes charge that transfer tax. And that transfer tax can be $5.10 per thousand of the value of the home. So it can get kind of costly. So it's things to remember if you're doing something like that, right? And of course, mortgage interest. Generally on the day you close, from the day you close until the end of that given month, you're going to pay X amount of days of interest. If you close in the middle of the month, 15 days of interest. If you close at the end, 5 days of interest. And that just, depends on when you're closing. And the reason that happens is, if like we talked about earlier about skipping a payment, you don't really skip a payment because mortgage interest is always paid in arrears. So in that hypothetical, we were saying if you closed in May, your first payment would be due in July, and you skip June. Well, the reason is that July payment is actually paying all of June's interest. And so since June's interest is paid, but you closed in May, somewhere somebody has to pay the May interest. And those are the days of interest that you pay when you go to closing. So there's all of that in terms of closing costs. And of course, tax benefits of being a homeowner, right? It's always a good idea, right, to know what your tax benefits are. You always want to talk to your tax professional to get the best advice. But there are some tax deductions that can reduce your taxable income. Mortgage interest, property taxes, PMI, and even points that you pay on the loan can be tax deductible. So you'll want to look into all those things to see if you're eligible for any of those deductions, if it makes sense to itemize versus taking the standard deduction, all of that stuff, right? And then we come to our last slide where we thank you for being with us tonight. I don't know if we still have time for some questions or anything. Let me check the chat here, and I can see if I can see that. It's opening up. My computer seems to be having a little bit of a lag today. We'll give it just a second, but I'll see if I can answer some of these questions. I don't see very much in the chat right now, but of course it could just be that my computer's lagging, right? But I will touch on some questions that we've had come in from other seminars that we've done and some that we had in anticipation of this one. And, one of them was, what technically qualifies you as a first-time home buyer? And so technically the rule is that if you haven't owned a home in the last 3 years, you are technically a first-time home buyer. So if you owned a home, in 2005 and you sold it in 2010, at this point, you're a first-time home buyer. And I see that Julie just asked that question, right? And it says, can you ever qualify again if you owned one before? And the answer to that is yes. You can be a first-time home buyer if it's been more than 3 years that you've owned a home. Now, there is an exception to that rule where if it's kind of an odd exception, but previously, if you had a home and then you and your partner split, and because of that, you had to leave the home and you have to start over, often there is an exception that can qualify you as a first-time home buyer again. So if you're in that situation, your lender will usually know and can let you know what that looks like, right? The other question we have a lot is, are there any, programs available for first-time home buyers? And there are. There's a bunch of different ones, right? Right now, the state has one called the Workers Advantage. There is the Home is Possible program. The Culinary has a program if you're a culinary union worker. There's a bunch of them, and they change. They come out. We have one called the Mid Income Program that can give you $50,000. It comes out like once a year, but the funds go very fast for that one, right? But there are all sorts of programs, and they all have their different criteria. Usually, the biggest criteria is income, right? How much you're making. A lot of them have limits as to how much you can make, and they all have their different limits. Some of them base the income just on the qualifying borrower that's listed on the loan, and some of them base their income limits on the household income. So it can vary. This is where you'll want to get together with your loan officer. Ask them like, hey, what programs do you have? Are there any that are eligible for me? And a lot of times we'll have to review your scenario to know for sure. We'll have to look at your income and your taxes and how many people are in your household, because there's even scenarios for that. Like if you have more people in the household, they'll let you make more income, versus if it's a one person household, the income limit is lower. So there's all sorts of varying programs like that, but we do offer a bunch of them. And then another question we had was regarding bankruptcies, right? Someone was asking like, what if my spouse had a bankruptcy, or what if I had a bankruptcy, or what's the wait period if I had a bankruptcy, right? So we refer to this as a credit event, a significant credit event, right? Bankruptcy, foreclosure, short sale, they're usually looked at as significant credit event, right? For a bankruptcy, let's say your spouse had a bankruptcy, this will kind of depend on the type of loan you did, right? If you did a conventional loan, you can apply for that loan on your own without any consideration of your spouse. So if you're not using one of these, down payment assistance programs or whatnot, because they may have an overlay that says, we don't have to have the spouse on there, but we have to consider their income, right? But in regards of credit, if you're doing a conventional loan, you can apply for that loan completely by yourself and not have to put any of your spouse's information on there. So if they had a bankruptcy, but you didn't, doesn't make any difference there. Now, let's say you did have a bankruptcy, right? Generally, it depends on the type of loan you're doing. An FHA loan will require that you wait 2 years from the discharge date. And that's not the filing date. That's not when you first filed for bankruptcy. It's when the bankruptcy was discharged. Oftentimes, that can be a year later, 2 years later, just depends on how long it took for it to get discharged, right? So for FHA, you have to wait 2 years from that discharge date. For a conventional loan, you have to wait 4 years from that discharge date. Conventionals do allow for an extenuating circumstance when you can have a 2-year wait period, but generally you have to prove some sort of significant event that reduced your income by like 20% to show that. They do consider divorce as a significant event. So sometimes people say, I got divorced and I lost, half of my household income, so I had to file bankruptcy. Often a conventional loan will consider that, right? In terms of how far back, someone just asked, I think VJ asked, how far back on credit report do we look? We'll usually look as far as the credit report reports, and often that's 10 years. For credit reports, we usually look back about 10 years. That's when like bankruptcies and things like that fall off. 7 years is usually when, like a foreclosure is forgivable and those kind of things. So if you do a foreclosure, realize you might have to wait 7 years before you can buy a house if you're doing a conventional loan. For a FHA, it's 3 years again. VA tends to follow the FHA wait period. So if you're doing a VA, they're a little bit more lenient like that. And VA is a lot more lenient when it comes to a lot of the guidelines than conventional loans or FHA is. So it seems to, if you're eligible for VA, VA is often one of the best loans you can do. People often think you can only have one VA loan out at a time. That's not correct. You can have more than one VA loan out at a time, and you can use your VA more than once, right? So VJ also asked, what are super negatively impacted items in credit where you guys might say, or ew, I can't say like ew about a home buyer, right? There really isn't much, right? Because as a loan officer, I'm always, one of the biggest things I always say to people when they call me is that it's not whether you can get approved for a home loan. It's if you can get approved for a home loan now, right? If there is some items on there or some issues on your credit usually that are barring the way of you being able to get approved, like a foreclosure or a recent bankruptcy, or perhaps, well, here's a big one that people don't even think about. But if you have a 30-day late mortgage payment on your mortgage, right, and maybe you're trying to buy a new house or you're trying to refinance, you will not be able to qualify for that loan generally for 12 months from the date of that mortgage payment, that late payment. So you'll want to keep that in mind just to make sure that there's nothing there that's affecting you when you're trying to buy a house. But if some of those issues exist, whether it's low credit score or debt to income ratio, or maybe low funds for down payment or things like that, what I would usually try to do is sit down and say, okay, we can't do this loan right now, but if you focus on paying off these items and then come back in 3 to 6 months, maybe your debt to income ratio is in line, or maybe we can work on some areas of your credit to bring your credit score up. So now you could qualify for an FHA, or you could qualify for this type of loan. And there are scenarios sometimes where, for example, an FHA will let you have a FICO score as low as 580, but a conventional loan will not. And FHA is usually the more lenient of the two. However, for example, let's say you own a home currently and you want to buy a new home, and you're thinking that you want to rent your current home and then buy your new home. If you try to use an FHA to buy the new home, FHA will not count rent from your departing residence unless that house is 100 miles away. So in that scenario, often you can't qualify with both house payments counted against you without counting the rental income from your previous home. So in that scenario, you have to go conventional. And maybe you've got a 580 and conventional will only take a 620. Then that means we got to figure out a way to get your score up to 620, and then that might be like, let's focus on this. Let's pay this balance down. Let's consolidate some debt, whatever it might be. You know what I mean? But we'll look at some different ways to get that done to get you to 620. And the thing to remember there is that even though a conventional accepts a credit score as low as 620, it doesn't guarantee you're going to get approved. So those are things to look at, right? So then another question that VJ had, right? I love these questions, VJ. Is it considered good or not so good to have some debt while going through the home approval process, right? And that is all, so in this case, they're saying credit card debt of 10K, give or take, right? This is going to translate to debt to income ratio, right? What's that payment? The debt isn't really going to matter unless it's affecting your credit score negatively, right? Maybe you're maxed out and that's bringing your credit score down. It could affect you there, right? But let's say you have, 3 different credit cards and they all have $20,000 limits, and you have, 5,000 on one and 2,500 on the other two. You've got a pretty low usage there. So that shouldn't affect your score too much, but your payment's good, right? What are the payments on these accounts, right? How does that payment affect your debt to income ratio? And if that's a scenario, right, where maybe like, hey, you've got some credit cards here and they're high payments, you can opt to say like, okay, I'm before closing, I'm going to pay off this credit card or these 2 credit cards or these debts so that my debt to income ratio does get in line to qualify. And that can work. We can take that into consideration, right? So Julia asked, can appointments be made to overlook where a person currently is to see their odds of being approved? And yeah, we highly suggest that. Like if you're considering buying a home, some people say like, oh, if it's 3 months or 6 months, I'd say if like you're thinking about buying a home next year, go ahead and apply, look into applying, right? And then we can look over all, the scenario. We can look over your credit. We can look over your income. We can look at different things, because sometimes there are situations where someone might say, oh, I'm working 2 jobs, so I think I should be able to qualify. And my first question in that scenario is, well, how long have you been working these 2 jobs, right? Did you just start working a second job? Because generally, to consider income from a second job, you need to have been doing both jobs for a 2-year period without any break. So there's things like that we want to look at and consider. And that might be something where if you wait till, 3 months before you're supposed to be out of your apartment, can come up, it can be a problem. Whereas if you reach out ahead of time or when you start thinking about it, it can kind of help you set up for that scenario, right? So definitely, I suggest, apply, look at it. Some people are hesitant to apply because they don't want their credit score to get pulled. But often your credit score pool is going to be a minimum hit. It might be like 5 points, maybe 10 points, depending on your overall credit picture. And often having that knowledge is better than taking a little 5 point hit, because usually within 2 to 3 months those points are going to recuperate and your score is going to be right back where it was. But now you're going to have the knowledge of where you need to be, or if you're ready to buy something now. And if any of you were kids in the 80s like me and you grew up watching GI Joe, you know that knowing is half the battle, right? So you gotta know what you're dealing with. You gotta know your credit scores. You gotta know what issues you have. You gotta know what income you're dealing with. And this is where your lender is gonna come into play, right? Um, so VJ asked, if one person works multiple jobs, will all that income be considered? And that's just going to depend again on how long you've had those jobs. Usually for more than one job, they want to see that you had a history of doing that for at least 2 years. But someone could have, depending on their line of work or whatnot, they could have 2, 3, 4, 5 jobs, whatever it might be. Maybe they've got a small side business that's like self-employed and they're doing that on the side. All those things we can take that into consideration, but you've got to have that work history. So that's pretty much it for the questions tonight. There's going to be an email of the questions we went over and the presentation that'll go out to everybody. It'll also, I think, be available on our YouTube page. It has been in the past, so I think that'll be on there as well. And if you have any questions or anything, feel free to reach out to the credit union. Anyone in the mortgage department is always available. You can always call me directly. We're here to answer any of your questions. And like we said, we want to help to create the life you want. Thanks so much for being here tonight.
Thank you, everyone. Have a good night.